Hello friends, last week in my video I gave you 4 factors that would determine how the markets would behave. And some of these factors that I mentioned, like a rising US dollar index, higher crude oil prices because of the hurricane season, are still present. And I also wrote in my live mint column that bulls are encountering some amount of challenges. Well, everything was going as per plan till Thursday, and Friday you received a surprise pullback in the market. Now, bulls still face a wall of worry, and in this video I want to discuss whether bulls will be able to climb that wall of worry and what will happen most likely in the week ahead. Coming up on your screen now is the market roundup window, which tells us that it was the broader base Nifty 50 which rallied more than the Bank Nifty. The US dollar index climbed above 104 levels, and that exerted pressure on emerging market indices, but India happened to buck that trend. The Indian rupee, which is the USD INR, showed strength, which is the rupee basically slipped 14 basis points versus the dollar, and that also limited the upsides in the market. Gold and silver went up due to short covering and fresh worries over inflation due to strong rally in oil and gas prices. Do remember, this is the hurricane season, and there is also constraints of output, both due to deliberate output cuts as well as strikes in Australia, which are likely to impact natural gas supplies. The Indian 10-year benchmark bond yields fell 3 basis points, which means bond prices went up, and that provided a certain amount of relief to banking stocks. NSE market capitalization rose by over 1.5%. That tells you that the rally was broad-based. MWPL fell along routine lines because it was an expiry, and the US indices provided bullish triggers. All 3 indices rose. That provided tailwinds to Indian markets. Now friends, I come to our in-house indicators, and I start with the market-wide position limits, or MWPL. Now these are limits utilized by traders as a component of total limits allowed by SEBI. Every 4 weeks, you witness a big decline that is due to expiry, which is routine. And the last expiry has seen the MWPL fall to 28.27, which is higher than the prior expiry low of 28.12, which means risk appetite remains higher. The trajectory is higher tops and higher bottoms, which also tells you that volatility will continue to rise, because the buildup of bigger positions really means that one of the two sides will surrender their positions when they lose, and a huge amount of positions will have to be squared up. That will lead to bigger price swings. Let's now go to the stock and index futures turnover. These are 3 concurrent series, which is September, October, November. There's been a sharp spike in turnover in both indices and stock futures turnover. One Marshmallow traders have participated fairly well in the markets. And remember, the first 4 trading sessions of the week were rather cautious. So volumes have come on days when markets were falling as well. And expiry of the August series has also seen volumes go up, because on expiry, volumes tend to double up. You square up positions in the expiring month and initiate those same positions in the following month. That records expiry twice. So every 4 weeks, you'll see a sharp spike. Now for the advanced decline ratio, which measures the number of shares losing versus the number of shares gaining. This is an average of all 5 trading sessions of the week. What you are seeing is that the Nifty has recorded positive gains on a week-on-week basis after staying in the negative for 4 consecutive weeks. And the advanced decline ratio has risen from 1.20 in the prior week to 1.37 last week. That tells you that for every 100 losing stocks, there was 137 gaining stocks. That means intraday buying conviction was relatively stronger. Now, the advanced decline ratio is at the upper end of the 20-week range, which means there could be some cool off, at least in the ratio. I'm not saying the indices, but in the ratio, the buying momentum may just see a little bit of a tapering off. Now we come to the basis of the Nifty 50 and the Bank Nifty. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Both the indices have logged a very smart rise in basis, not very surprising due to expiry and 4 full weeks available to traders to trade these indices. They are willing to pay a higher premium. Just like options premium, the basis also tends to erode over time, and therefore at some point in time in the coming week, the basis might just see a little bit of a tapering off. Now for our in-house indicator, the impetus, which you won't find anywhere on the internet, what you are seeing is the Nifty impetus has fallen, whereas the Bank Nifty impetus has flattened out. Now do remember that the Nifty 50 has actually logged higher gains compared to the Bank Nifty. And the gains on the Nifty 50 have come on a falling impetus, which means force in buying was not really there. And to be very honest, let's be rational about this. Majority of the gains that you are seeing in the week have actually come due to the gains made on Friday. The Bank Nifty has been more or less quiet compared to the Nifty 50, and the impetus is also flatlining. So there was not much momentum in the indices here. I now come to another in-house statistical indicator, the LWTD, Lift, Weight, Thrust, Drag Index. Now, like I said earlier, the Nifty recorded 4 weeks of consecutive losses, and last week it has jumped into positive. But the LWTD indicator has actually come into negative, which means higher levels might just witness relatively milder fresh buying support. Short covering is something else. That's a different kettle of fish altogether. But fresh buying supports may be a little labored, and that's what we need to watch out for. This is a weekly chart. We need to monitor the daily chart, which I update on my social media accounts every evening, late evening. So do connect with me there and stay up to date. Friends, our in-house indicators done. I now come to the bond market, which you know is very close to my heart. We've been talking about bonds before the equity indices for many, many years, because this market funds the markets of all other asset classes. And do remember that Indian 10-year benchmark bond yields have fallen 3 basis points, as the weekly chart on your screen tells you. For the 3 consecutive weeks, the Indian 10-year benchmark bond yield has recorded red or bearish candles. Now we are at no man's land. And either we breach the 7% mark, where you start to contemplate going in for gilt funds, or you break out above the 7.5, 7.6 yield and then start to ladder again. So far so good. We are just staying steady here. Friends, there's also been an important development. Advisors to the RBI have basically suggested that the RBI mop up a lot of long tenure bonds to the extent of 15,43,000 crores in the coming few months. Now that means that the RBI will pick up money for long term to the extent of 15,43,000 crores and pay interest possibly slightly higher than the Indian 10-year benchmark bond yield at 7.17, which was the closing on Friday. What does it actually mean? That means the liquidity might be impacted a little. Will it drive up yields? I think it might. There is a fair probability that yields might just go up a little. How much? We really don't know. We are in the zone of conjecture right now. But I will keep posting my views, which I do in great detail on our free Telegram channel. Do connect with me there and stay up to date and ahead of the crowds. Friends, the bond market's done. I now come to the Bank Nifty, which basically gained a little less than the Nifty 50. It rose, as you can see on the daily chart on your screen, on 3 out of 5 trading sessions. Wednesday and Friday were prominent power candles. Power candles are candles that are larger than usual, and they see a lot of activity. The peak of Wednesday remains inviolate even though the markets rallied sharply on Friday, and the peak is at 44,780. This must be overcome if intraday traders are to get back in the driver's seat. The head and shoulder formation, which I had indicated to you a couple of weeks ago, remains in place. The neckline is where the markets have closed on Friday, and we need to see whether the market stays above the neckline and its month-long moving average when short-term traders will now get out of mark-to-market losses and witness a relief where M2M payouts are concerned. The weekly chart on your screen shows that the Bank Nifty, has gained for the second week in a row, and the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull, has proved to be a reliable support at this point in time. So the medium-term outlook remains positive, but for now, the 43,830 is a support level to watch out for in the absolute near term. This is the week's low on the weekly chart on your screen. Friends, in the week before last, this index was at number 4 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It fell 2 notches to number 6, which means, relatively speaking, volatility levels eased. Therefore, retail traders will find the challenge level down a bit. Last week, I advocated an estimated range between 45,350 on the upside and 43,125 on the downside, which held perfectly well. In the coming week, I estimate a range between 45,525 on the upside and 43,325 on the downside. Let's be careful out there and trade light. Friends, the Bank Nifty done. I now come to the Nifty 50, which rallied 0.88%. As you can see on the daily chart, it rose on 4 out of 5 trading sessions, and relatively speaking, of course, the chart looks relatively better than the Bank Nifty, and what you are seeing is that the significant low of 19,225 is an area to watch out for the absolute near-term intraday traders. The 19,585 is a resistance area to watch very keenly in the absolute near term. The price remains at the threshold of the month-long moving average, which means the short-term outlook is tentative as of now. The weekly chart on your screen tells you that the price is comfortably above the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull, which means the medium-term outlook, relatively speaking, of the Nifty is better than the Bank Nifty. The 18,887 level is a previous swing high made in December 2022, which will be a support area to watch out for the medium to long term investors. Friends, in the week before last, this index was at number 6 on our most volatile counters list that we maintain in-house. Last week, it slipped pretty sharply to number 13, not because the volatility came down that much, but because individual stock futures volatility, relatively speaking, shot up much more faster than the Nifty 50. Last week, I advocated a range between 19,650 on the upside and 18,900 on the downside, which held perfectly well. In the coming week, I estimate a range between 19,800 on the upside and 19,050 on the downside. Friends, I now come to the last bit of statistical data analysis, wherein I gauge the retail risk appetite by the footprint of the turnover contributed from the 4 derivative segments in the market. What you're seeing on your screen is index futures turnover, which is indicated as a blue line, has gone up by 3 basis points compared to the previous week. And stock futures turnover has risen, which is indicated by a red line by almost double the amount of contribution. That tells you risk appetite definitely was higher. Now this turnover also goes up due to expiry. Every 4 weeks you will realize there's a spike coming in. This is rolling over and dual turnover recording. Where index futures index options turnover is concerned, it's indicated as a green line. The contribution percentage went down, and so did the stock options turnover contribution, which is indicated as a purple line. So higher risk appetite instruments, which is futures, saw higher participation. Part of it, of course, is due to expiry, but risk appetite, like I said, especially due to Friday, remains high. Friends, I now come to the segment wherein I discuss what I would do in the coming week. Number one, I would trade light. Volatility is fairly high. Number two, I would seek opportunities in oil marketing companies, OMCs, especially if crude oil continues to rise the way it did last week. And metal stocks, they might continue to witness buy on declines because base metal prices or industrial metal prices on commodity exchanges remain firm. Oil and gas will continue to gyrate or move to news of due to output cuts, and strikes in Australia, and OPEC guidance about official selling prices and export cuts by Russia, if any. If the US dollar index, the Dixie, rises further, emerging markets may see a limited upside in the week ahead. Friends, I now come to the most popular segment on this video for statistically minded traders and online family members of mine. I give you 5 stocks that gain the most amount of statistical impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks that lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. These are for scalpers. Remember, the list is valid only for Monday. Tuesday through Friday, I update this on our Telegram list. This is just momentum falling and rising. Direction will be determined by the market. So, statistical impetus gainers list is led by MCX, followed by TVS Motor, then Deepak Nitride, Steel Authority of India Limited, and Atul. Impetus losers list is led by TCS, REC, Aurobindo Pharma, PI Industries, and Kotak Bank. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping your journey to improving your trading performance. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Take care. Bye-bye.